Which loan program offers the best rate, the best terms, and the lowest monthly payment? I'm often getting people reaching out to me asking me which loan program is best for them. And they're usually comparing conventional financing to FHA financing. So what I want to do in today's video is break down the differences. We're going to talk about the differences in credit score, differences in down payment, differences in debt to income ratio, differences in mortgage insurance, gift funds, employment, everything you need to know to decide which loan program is best for you. Now understand, in some scenarios, FHA is going to be a better loan program for you. And in other scenarios, conventional financing might be a better program for you. But what we're going to do here is break them down, and then we're going to give you some monthly payments. We're actually going to break down FHA loans versus conventional loans with two different credit scores to show you which loan program offers the best rate, the best terms, and the lowest monthly payment. Now, before we dive into that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. It helps the YouTube algorithm push it out to more people like you. And if you like content like this, do me a favor and hit that subscribe button. Now, while there are some similarities between conventional financing and FHA financing, there's also some big differences. And one of the primary differences in the two loans is the credit score requirements. FHA allows you to purchase a home with as low as a 500 credit score, whereas conventional financing requires at least a 620 credit score. Now, with that said, if you're buying a home and you're using FHA and you have below a 580 credit score, it's going to require a 10% down payment. If you have above a 580 credit score, it requires a 3.5% down payment. And that's also one of the big differences versus conventional financing. Conventional financing allows as little as a 3% down payment, but once you go below a 680 credit score, you're going to have to put at least 5% down in order to get conventional financing to approve it. Now, with all of that said, I often have people reaching out to me saying, hey, Jeb, I have a 500 credit score and I have the 10% down payment, but the lender is telling me that I don't qualify. Understand that just because you meet some of the basic requirements in today's video doesn't necessarily mean the lender is going to approve you for the loan. There are some additional requirements that we're going to talk about today, with DTI being one of the big ones, but there's also some other requirements with regards to employment, with regards to income that you need to satisfy in order to get approved, especially when you have some of these lower credit scores. The lower your credit score and the lower your down payment, the more difficult it's going to be to qualify in many cases, is oftentimes it requires a lender to manually underwrite that loan. And when lenders manually underwrite loans, they go through the file with a fine-tooth comb. So they're looking at everything versus in the cases when you get an automated approval, it's more or less a slam dunk as long as you can satisfy the lender's conditions at that time. So we've talked about the differences in credit score. We've talked about the differences in down payment. Now I want to talk about the differences in debt to income. Now, debt to income is one of those things that can be very difficult for a consumer to understand because of how it's calculated. But your debt to income is basically just your debt versus your income, which means they take up all of your expenses on your credit report, things like your student loans, things like your car payments, things like your credit cards, in addition to your proposed housing expenses, how much your mortgage is going to be, how much the property taxes are going to be, how much your mortgage insurance, your property insurance. If there's a homeowners association, they take all of those fees, they add the debts that come from your credit report, and then they take that total amount and they divide it by your gross monthly income, which is your income before any taxes are taken out. So in the case that you have a monthly mortgage payment with everything included at say $3,500 a month, and let's say you have another $500 in monthly debt that shows up on your credit report, well, that's a total of $4,000 in debt. Well, let's say that you make $120,000 a year. Well, that's $10,000 a month. So what they do is they take that $4,000, they divide it by that $10,000, which says that your debt to income ratio is at 40%, which in the case of FHA and conventional, you should qualify based on that debt to income ratio alone. But one big difference is FHA is way more lenient, as they allow you to go as high as a 57% back-end ratio, whereas conventional financing, you really have to stay under 50%, which means that when using FHA, you can actually qualify for more home with more debt using FHA than you can with conventional financing. And that's a big reason that a lot of people go towards FHA, is because it's a little bit more lenient, because it allows lower credit scores as well as a lower down payment. Now, with that, there are some requirements that both loans have when it comes to mortgage insurance. Conventional financing is going to require mortgage insurance when you put less than 20% down. So anytime you buy a home with less than 20% down, you're going to have mortgage insurance. Whereas in the case you're buying a home using FHA financing, it's going to require mortgage insurance whether or not you put 3.5% down, you put 5% down, 10% down, 50% down. There's going to be mortgage insurance on that loan. Now, with that said, if you put at least 10% down, the mortgage insurance will fall off after year 11. But in the case that you put less than 10% down, that mortgage insurance is going to be on it for the life of the loan. Now, with that said, there's a lot of people out there that are looking to buy homes that don't have 20% down, but are also saying, I don't want to use a loan program that's going to require mortgage insurance. I want to avoid mortgage insurance. Therefore, I'm going to continue saving until I have at least 20% down to buy a house. And that's okay if that's your plan, but don't get scared of mortgage insurance. I personally believe there's a lot of misinformation out there about mortgage insurance that scared people away from buying homes because of mortgage insurance. Understand, mortgage insurance is not a bad thing, especially if you don't have the full down payment for 20%. In fact, I'm going to show you a couple of examples today comparing FHA to conventional loans where the mortgage insurance is a little bit more expensive than, say, conventional financing, but the monthly payment ends up being lower. And so with that, I feel like right now is a really good time to talk about effective interest rate. Effective interest rate is essentially your interest rate plus your mortgage insurance, if you will. So in the case that you get an FHA loan and the interest rate is 6.5% and your mortgage insurance is 0.55%, that means your effective interest rate is 7.05%. So more or less just over 7%. But on the flip side, if you get a conventional loan and the rate is 7.125%, 7.125%, then your effective rate is 7.125%. Or maybe in some cases of that conventional loan, there's also mortgage insurance at 0.45%. So in the case that you have an interest rate at say 7.125%, you have to add that 0.45 on top of it. So you're looking at an effective interest rate over 7.5%. So when you're comparing conventional to FHA, just make sure you're comparing the full effective rate. And don't get scared of having mortgage insurance. You can always refinance out of it at a later time. At the end of the day, most people aren't going to keep the same loan for a 30-year period of time to start with. So if you get equity in your property, you get to a time when you're looking to sell your property, maybe you're looking to pull cash out or do something in the future, you can refinance that loan. And if you're in an FHA loan, you can go to a conventional loan if you want to. But either way, your effective rate is your effective rate, which means it's whatever your interest rate is plus the mortgage insurance on top of it. So make sure you're using that when you're comparing the two loans. Now, I know some of this can be difficult to understand when talking about effective rate, when talking about comparing the two loans. That's why it's always super, super important to make sure you're working with a mortgage professional. You're not watching my video, going out and trying to calculate your own numbers or seeing if you qualify. Talk to a mortgage professional, somebody that does this full time, someone that understands the stuff and can guide you in the right direction. If you don't have that person, I've taken the time to create a link below that will refer you to somebody I know, like, and trust that can guide you through that process. And something to keep in mind, it's completely free. They'll give you a comparison comparing FHA to conventional and ultimately help you decide which loan program is right for you. Now, on top of that, FHA does have some other requirements. If you're buying a condo, FHA requires that that condo is FHA approved, whereas conventional financing doesn't have that requirement. So in some cases, conventional financing can be better, especially when you're looking at condos, because it gives you more options. On top of that, another really nice thing about FHA financing is it also allows you to put that minimal down payment when financing units. So if you're buying a 3 or 4 unit property, you can get away with that minimal down payment of say 3.5%. Whereas when you're using conventional financing, once you start to buy units, it's going to require more money down. Now, the last thing I want to talk about before comparing the monthly payments on these two different loans is that both loans require 2 years of consistent income and consistent employment. Now, that doesn't mean you can't have gaps. It doesn't mean you can't change jobs, but it needs to be a consistent line of work and you need to have consistent income. Now, with that, FHA can actually be a little bit more strict when you have gaps. If you have a gap on the job, you need to have at least 6 months back on that job in many cases. But this is another thing that you want to talk to a lender about, because a lender can really go through the specifics of it, check with an underwriter and give you an example based on your situation versus just a general statement in a YouTube video. And one more thing, both loans allow gift funds. So if you're somebody that's getting a down payment, has the ability to get a gift for a down payment, both FHA and conventional financing allow that with no problem. Now, earlier in the video, I said I was going to compare two loans. Now, what I want to do is compare FHA to conventional financing using real numbers. In today's example, we're going to be talking about a $350,000 purchase with credit scores at 780 and credit scores at 680. And we're going to look at a 10% down payment versus a 5% down payment. So the very first example I want to talk about is a conventional loan putting 5% down, putting 10% down with a 780 credit score. Now we're talking about buying a single family home, which I know for many people out there watching this video, you can't buy a $350,000 home in your market, but this is just to give you a really good idea, because if one loan program is better than the other at 350, as you go up to 500, you go up to 750, you can see how much of a difference it will make in those loan programs. So in the case of conventional financing, based on today's rates, you'd be looking at an interest rate of 7.125%, which means if you're buying a $500,000 home, putting 5% down, that's $17,500, which means you're financing $332,500, which would give you a mortgage payment of $2,240 a month. Now for property taxes, we're going to be using 1.25%. Now for some areas of the country, that's going to be a high number, and other areas of the country, that's going to be a low number. Just make sure wherever you are, you're using the tax rate for your area. But based on 1.25%, you're looking at $364 in monthly taxes. On top of that, you're going to have property insurance. Property insurance, based on a calculation of 0.0035%, is going to give you $87.50 per month. The mortgage insurance is going to be based off using two borrowers. The reason I'm saying this in this video is because two borrowers actually get a better mortgage insurance rate than one borrower. So if you're a single borrower and you have a 780 credit score, your mortgage insurance is actually going to be a little bit higher than what I'm quoting here, but that number is going to be 0.23%, which means your mortgage insurance is going to be just over $63 a month. So all in, you're looking at a total mortgage payment of $2,755, putting 5% down, using a conventional loan with a 780 credit score. And the 10% calculations would be more or less the same thing. The interest rate also be 7.125, but the mortgage insurance would actually be a little bit different. It would be 0.14%, which is a total of $36.75, making your total mortgage payment $2,611 per month. Now what I want to do is compare that to FHA, but before I do that, I want to compare it to conventional with a 680 credit score, because a 680 credit score isn't an awful credit score, but you'll see how much that 100-point difference in your credit score actually impacts your monthly payment when doing conventional financing. So in the case of conventional financing, putting 5% down, your interest rate's going to be 7.875%. So that's 0.75% higher, 0.75% higher by having 100 points lower in your credit score, which gives you a mortgage payment of $2,410 per month. Property taxes are going to be the same at $364. The property insurance is also going to be the same at just over $87, whereas the monthly mortgage insurance is going to be higher at 0.68%, giving you a monthly mortgage insurance payment of $188, bringing your total mortgage payment to $3,051 per month. That's $296 higher than the borrower that had a 780 credit score. So you can see how much that credit score impacts your monthly payment. Now I want to do the same thing for 10% down. At 10%, the interest rate's also going to be 7.875%, bringing your mortgage payment to $2,283. The property taxes are the same, the property insurance is the same, but your mortgage insurance is going to be 0.46%, bringing that amount to $120 per month. So giving you a total monthly mortgage payment of $2,856, which is $245 higher than that borrower that had a 780 credit score. Now, how does FHA compare to the two scenarios I just gave you? Well, one nice thing about FHA in this case is that the interest rate is the same with a 780 credit score and a 680 credit score. And in this example, that interest rate is 6.5%. So it's considerably better than the conventional financing. Now, while FHA does allow a minimal down payment of 3.5%, in today's video, we're doing a 5% down and a 10% down option just to compare it to conventional financing using the same number. So in the case of the FHA loan, putting 5% down, you still have the same down payment of $17,500, but the biggest difference is FHA has upfront mortgage insurance of 1.75%, which means they charge you 1.75% on top of your base loan amount in order to do FHA financing. There's no way around this. Doesn't matter if you put 5% down or 50% down, you have upfront mortgage insurance. Now, it can be financed or it can be paid out of pocket. Most people just finance it, which means instead of having a base loan amount of $332,500, you're actually going to have a base loan amount of $338,319. That's because you're financing that $5,819 upfront mortgage insurance on top of your loan. But here's the thing, your interest rate is quite a bit better, as we said earlier, which means your monthly mortgage payment is going to be $2,138.40, which is $102 less than the conventional loan. The property taxes in this case are going to be the same at $364. The property insurance is going to be the same at $87, but you are going to have monthly mortgage insurance. In this case, it's 0.55%, which is $155.06. Now, remember earlier when we talked about effective interest rate, in this case, the interest rate is 6.5%. The mortgage insurance is 0.55%, which means your effective rate is 7.05%. Now remember, with conventional financing, same scenario, the interest rate was 7.125%. So in this case, the effective interest rate with FHA is actually lower than conventional financing. But all in gives you a total monthly mortgage payment of $2,745 a month, which is $10 less than that of conventional financing. Not a huge difference in the 780 scenario, but it's a huge difference when it comes to the 680 credit score, is that's a $306 difference in your monthly payment. So in the case that you have a lower credit score, in this case a 680, you're way better off using FHA financing than conventional financing. But how does it look at 10% down? Now with 10% down, your base loan amount before you add the upfront mortgage insurance back is $315,000. But the upfront mortgage insurance is $5,513. So the amount that you're financing is actually $320,513. The interest rate is still the same at 6.5%, which gives you a total monthly mortgage payment of $2,025 per month. Property taxes are the same, property insurance is the same, but in this case, your monthly mortgage insurance is actually going to be a little bit less at 0.5%, bringing that monthly amount to $133, which gives you a total monthly mortgage payment of $2,611. Now, when you compare that to the conventional financing with the 780 credit score, it's basically the same monthly payment. So in that case, you might do conventional financing. But in the case of the 680 credit score, that is once again a $245 difference in your monthly payment. So for most people out there, FHA would be the better loan when comparing it to conventional financing. But like I said earlier in the video, if you're out there shopping for a loan, make sure you're having your lender run conventional numbers and FHA numbers and compare them side by side. That way you can see both figures and decide for yourself which loan is the right program for you. Now, often what I find is when people are watching this video, they're usually first-time home buyers trying to figure out which loan program is right for them, trying to figure out which direction they should go. And if that's you, there's something I want to mention. I created a first-time home buyer course to guide you through this process, really A to Z, talking about everything from loan programs to writing an offer, how to negotiate, and the things you need to think about when buying a house. So if you're interested in learning more about how to become an expert when buying a home, do me a favor and check the link below. Now, in order to make this video on the shorter side, there are some things I left out when comparing FHA to conventional. So if you're one of those really detail-oriented people and you want all the information, I've put it in both of these videos right here.